All right, let's talk about something that sounds, a little dry, an accounting standard. But stick with me, because this is not going to be your typical textbook lecture. We're actually going to tell a story. The story of the physical things companies own. We'll follow an asset from the moment it's bought to the day it's finally sold off. It's kind of like the secret life of a delivery truck, and our guide for this journey is a rulebook called IAS 16.
So it all kicks off with this really basic question, right? If you're a company and you own a huge factory or a whole fleet of trucks, how do you actually put a number on all that stuff? Well, you can't just guess. There are very specific international rules for this, and they're called International Accounting Standard 16, or just IAS 16. Think of it as the official playbook for all the big, tangible things a company owns.
Okay, so first things first. What exactly are we talking about when we say stuff? To make this super clear, let's meet the main character of our story today, a brand new delivery truck. This truck is going to be our guide to understanding what accountants officially call property, plant, and equipment. Now, here's the formal definition, but let's break it down. Tangible just means you can physically touch it. You can kick the tires. Held for more than 1 year, that tells you it's a long-term thing, not something that gets used up in a few weeks. And the last part is all about its purpose. It's there to help run the business. So basically, it's the long-lasting physical gear a company uses to make money. Simple as that.
This covers a whole range of things. You've got the land a factory sits on, the factory building itself, all the machinery whirring away inside, and, yeah, even the boring old office furniture. And, of course, the star of our show today, our shiny new delivery truck, all ready to begin its life on the company's books.
So we've got our truck. We know what it is. But how does it get officially recorded in the company's financial records? This is where its story really gets going. We have to figure out its starting value, its day one price tag.
Before that truck can even get on the balance sheet, it has to pass 2 little tests. First, is it likely to help the company make money down the road? Well, it's a delivery truck, so yeah, check. Second, can we figure out exactly how much it costs to get it? Absolutely. Check. Those are the 2 golden rules. If you can't say yes to both, it doesn't get counted.
Now, the cost is a bigger deal than just the sticker price. It's everything it took to get that truck ready for its very first delivery. So you start with the purchase price, but then you add in any taxes, shipping fees, maybe even the cost of a test drive to make sure everything's working right. You bundle all of that up into one initial number.
All right, our truck is officially on the books. But its value isn't just going to sit there, frozen in time. Nope. This next chapter is the longest part of its life, tracking how its value changes while it's out on the road, doing its job year after year.
Every single mile that truck drives, every box it delivers, it's using up a tiny little bit of its value. In accounting, we call that depreciation. Now, this isn't about what the truck is worth on the used car market. It's an accounting trick to spread the truck's cost over all the years it's helping the company earn money. It's all about matching the expense of the truck to the income it's helping to generate.
Let's make this real with some easy numbers. Let's say our truck costs $100,000. The company figures they'll use it for about 5 years, and at the end of that, they can sell it for scrap for maybe $10,000. That's called the residual value. So you take the cost, subtract that final scrap value, and then you divide it by its 5-year life. Boom. That gives us $18,000 a year in depreciation expense.
Okay, so a year has gone by. We've recorded that $18,000 of depreciation, but what's the truck actually worth on the financial statements right now? This is where companies have to make a really big choice. And believe me, the path they pick can make a huge difference. So, there are 2 paths they can take. The first is the cost model. It's super simple. You just take the original cost and subtract the depreciation every year. It's stable, it's predictable. Then there's the revaluation model. This one's way more dynamic. You actually adjust the asset's value to what it's worth in the market today. It gives you a truer picture for sure, but it's a lot more work. And here's the catch. You can't just cherry pick. If you revalue one truck, you have to revalue your entire fleet of vehicles.
Now, why should you care about this? Because this choice can completely change how valuable a company looks on paper. Think about a real estate company that bought a building 30 years ago. Under the cost model, that building might be worth next to nothing on their books. But with the revaluation model, if that building's in a hot market, it could be worth millions. As an investor, you absolutely need to know which model a company is using. It's critical context. Of course, life isn't always a smooth ride, is it? What happens if something really bad and unexpected happens to our truck? This is a dramatic plot twist in our asset story,
and it has a special name: impairment.
So imagine our truck gets into a major accident. It still works, but it's pretty banged up. The normal, gradual wear and tear of depreciation just doesn't cover something like this. This is an impairment loss, a sudden, sharp nosedive in value. The value on the company's books is now way, way higher than what they could ever hope to get back from using or selling that damaged truck.
So, how do you handle this mess? Well, there's a process. First, you spot a red flag, like the big accident. Second, you calculate its new, lower recoverable amount. Basically, what's the most you could get for it now, either by selling it or using it. And third, you compare that to what's on the books and you write down the difference as a loss. It's all about being realistic and making sure the value on paper matches the new, damaged reality.
Well, all good things must come to an end. After years of loyal service, our truck has finally reached the last stop on its journey. It's time to take it off the company's books for good.
This final step is called derecognition. It's pretty much the official accounting term for saying goodbye. It doesn't matter if the company sells the truck, sends it to a scrapyard, or just parks it out back because it's not useful anymore. The point is, it has to be removed from the financial statements to keep everything accurate and up to date.
And there's one last little bit of math to do. Let's say after all those years of depreciation, the truck's value on the books, its book value, is down to $15,000. If the company manages to sell it for $20,000, great, they record a $5,000 gain. But if they only get $10,000 for it, well, that's a $5,000 loss. This just shows why tracking that book value so carefully over the years was so important in the first place.
So after all of that, you might be thinking, why go through all this hassle? The answer really comes down to one word: transparency. IAS 16 makes companies tell you all these details: which valuation model they use, how they're calculating depreciation, how long they guess their assets will last. It gives you, the investor or the analyst, a clear, consistent picture so you can fairly compare one company's assets to another's.
And that really brings us to our final thought for today. We have this incredibly detailed, complex rulebook that's designed to give us a true and fair view of a company. But remember, management is still making some key judgment calls here, like how long an asset will really be useful, or what it might be worth at the very end. So even if everyone is following the exact same rules, does that guarantee we're seeing the absolute 100% truth? That's a great question to chew on.